FTX, once the second largest crypto exchange, files bankruptcy. FTX, which was once a major player in the crypto market, has filed for bankruptcy. The news is shocking for a number of reasons. The balance sheets for FTX were never audited, and it's not clear how much of the assets were actually worth. The company's crypto assets were quickly converted to Ether and DAI on decentralized exchanges. FTX's balance sheets were never audited. FTX, once the world's second largest crypto exchange, filed for bankruptcy in Delaware on November 10. The filing provides a detailed picture of a tangled web of companies with little regulatory oversight. The company has been accused of failing to meet standard financial reporting procedures. This reportedly has led to an investigation by the U.S. Department of Justice and the SEC. One of the biggest red flags is FTX's failure to keep proper records of its bank accounts. FTX's accounts department failed to keep a list of its bank accounts and did not keep an accurate record of the money deposited by customers. This allowed FTX to use funds from its corporate accounts to purchase homes for workers in the Bahamas and personal items for its employees, and also failed to maintain security controls on digital assets. Another big red flag is FTX's failure to properly audit its financial statements. FTX commissioned two different audit firms for its 2020 and 2021 financial statements. They issued reports at the end of March 2022. Its balance sheet shows US $3.2 billion in illiquid assets and $5.5 billion in less liquid assets. These funds were difficult to track. The balance sheet also shows a large number of swings in the company's assets and liabilities. On November 10, FTX held US $900 million in liquid assets and $9 billion in liabilities. This is a big gap in FTX's balance sheet. This is one of the reasons FTX is facing major legal challenges. The FTX bankruptcy filing also paints a picture of a company that failed to properly monitor spending. FTX and its sister companies failed to properly follow financial reporting procedures, and also failed to maintain accurate records of employees. In addition, FTX lent billions of dollars to Bankman-Fried's hedge fund, Alameda Research. Bankman-Fried used the firm to finance his personal activities. He also used Alanda's funds to invest in Paperbird Inc., a company he owned with fellow FTX co-founder Nishad Singh. Other FTX employees received loans from Alameda Research. One of FTX's top executives, Ryan Saline, received a $55 million loan. Another FTX executive, Nishad Singh, received a $543 million loan. This money was used to purchase personal items for employees and advisors. FTX's crypto wallets drained $663 million in various tokens. FTX's crypto wallets were drained of $663 million in various tokens last weekend. The move was believed to be a hack. The tokens were then swapped for Ether on decentralized exchanges. The move is also a sign of the growing need for regulation in the booming cryptocurrency market. Cryptocurrency can be tracked on a network of blockchains. Using this technology, users can identify thieves. In the FTX case, unauthorized transactions were noticed within hours of the exchange filing for bankruptcy protection. The most important transaction was not a hack but a transfer, a wallet tied to the exploit swap stablecoins for Ether. The token can be sent to any address. The crypto tracing community is watching this transaction closely. Other notable actions are a court filing, a pinned tweet claiming the hack, and a new website. The latter is supposed to reassure skeptical users that the platform is safe. It's also worth mentioning that FTX moved the bulk of its digital assets into secure cold storage. This is considered the best protection against hackers. It's also worth noting that Binance has exited with $2.1 billion in BUSD. Binance was one of the first investors in FTX and was concerned about the exchange's stability. During the FTX's collapse, Binance tweeted about its intention to buy the exchange. While the FTX wallets were drained of $663 million in various tokens, the move was hardly the biggest. It may have been the smallest, but FTX is now making a show of trying to assure its users that it is safe. The FTX's website also warned users not to install any new updates and to steer clear of the FTX Telegram channel. This is in response to reports of missing tokens and a hack. The exchange is also removing trading functionality. Hopefully, these measures will help the company recover funds from its users. It's not yet known whether these measures will help FTX recover its funds from its creditors. However, it's clear that the exchange's users will suffer a huge blow if these funds cannot be recovered. FTX's crypto assets were rapidly converted to Ether and DAI on decentralized exchanges. FTX, the crypto exchange founded by Sam Bankman-Fried, was hacked last weekend for $663 million in cryptocurrencies. A large portion of the tokens were siphoned across multiple blockchains. The price of ETH crashed by 30% within 24 hours. As a result of the hacked tokens, traders were able to take advantage of the liquidation of crypto assets. Several decentralized exchanges saw significant volumes traded. However, the value proposition of truly decentralized protocols has been a bit elusive. While there are certainly decentralized exchanges, most exchanges still rely on third-party custodians. This is particularly true for crypto assets, which lack consumer protections. Moreover, many banks are reluctant to do business with virtual currency companies. This creates a ripe market for hackers. However, decentralized exchanges can be more secure than centralized exchanges. Decentralized exchanges are essentially smart contracts on the Ethereum platform. These contracts store user funds and collaterals. These assets can then be transferred and exchanged peer-to-peer. The decentralized exchanges are a growing industry. One of the most important features of a decentralized exchange is the fact that no third party is involved in the process. FTX was supposed to be separate from Alameda. However, Alameda supposedly had an investment in FTX, which was later transferred to Bankman-Fried. A significant portion of the tokens were siphoned across multiple chains, including the Binance Chain, Solana, and Chainlink. The FTX at Ally Hall was also notable for the presence of Tether, Shiba Inu, and Chainlink. Interestingly, FTX did not manage to recover all the lost funds. The firm released a court filing shortly after the tweet was sent. It's unclear whether FTX has a legal obligation to recover the funds. The company has been able to recover most of the crypto assets it holds. However, many other trading firms are at risk. The price of ETH has fallen by about 30% in the past 24 hours, and the price of MKR has dropped by about 50%. The State of the Network has published an interesting article examining the details of FTX's fall. However, there are many other investors who are responding by removing funds from FTX and other exchanges. FTX's bankruptcy raises serious questions about the future of digital assets. FTX's bankruptcy has sent shockwaves throughout the digital asset industry. It has set off a wave of regulatory scrutiny and a crackdown on risky crypto practices. The company is being investigated by the Securities and Exchange Commission and the Department of Justice. If any of the allegations turn out to be true, the fallout could have far-reaching consequences. A recent crash in digital assets has put many people in the cryptocurrency sector in a rut. Many traditional investors have been investing in the industry despite the prolonged bear market. However, FTX's failure left the industry in a scramble to get its money back. Many customers tried to withdraw their holdings from the platform, but the firm was unable to meet the demand. The company's failure has led to an inquiry by U.S. regulators into whether the firm improperly used customer funds. It is also the subject of a criminal investigation in the Bahamas. The company's assets could be sold in order to meet its obligations, but the fallout could have a wide-ranging effect on other companies. Many of FTX's customers could end up filing lawsuits and owing the company money. This could lead to an overly restrictive regulatory environment for the industry. The FTX bankruptcy is already the subject of investigations by the SEC and the Department of Justice. Both of these investigations could lead to criminal charges. If FTX's practices are proven to have violated the law, they could expose the company to even more legal problems. The FTX bankruptcy is the largest of the year so far. Other crypto lenders filed for bankruptcy this spring, including Celsius Network and Voyager Digital. In addition, Binance and Galaxy Digital have both filed for bankruptcy. In addition to the FTX bankruptcy, the recent crash in digital assets has put many companies in the crypto sector in a rut. Crypto assets are currently valued two-thirds lower than they were in November of last year. This makes the recent crash a well-timed one. However, it also presents challenges for Asia's crypto capital. It is possible that other companies will need to close their operations.